Hello guys, today we're going to talk about the Elliot Wave Theory of price movement. The Elliot Wave Theory was introduced by Ralph Nelson Elliot in the 1920s. The Elliot Wave Theory has withstood the test of time because as you may know, traders still use it 100 years after it was introduced. Elliot believed that the market moves in repetitive cycles and he named those cycles as waves. I'm going to help you understand how Elliot waves look by showing them to you using some slides I have prepared from cTrader. So let's go and see those slides. In the first slide here, we see a normal price action of EUR/USD H1. What we're looking on this EUR/USD 1 hour chart is actually a bearish Elliot wave. Let me go through you the Elliot wave theory and you will understand what's happening. So let's move to the next slide. The first wave is called an impulse wave. It's impossible to know if the first wave was indeed a wave number 1 or it's a retracement of a previous trend. So in this wave the previous trend is still in force and the market is going short, but the original trend is still in effect. The next wave, wave 2, on the second slide, is called a correction wave. Elliot waves are always either impulse waves or correction waves. It can never extend below the starting point of the first wave. It's actually a retracement of the first wave, and it most usually does not retrace more than 61.8% of the first wave. So we can use the Fibonacci retracement tool here to measure the retracement of the wave 1. Now let's move to wave 3. Wave 3 is usually the largest wave of all, usually, not always. And it's the one that clearly shows that the original bullish trend does not prevail anymore, as you see on this graph. Up until the wave number 2, one could argue that the uptrend is still in effect. But at the end of wave 3, no, there is no uptrend anymore. The corrective wave 4 usually retraces less than 38.2% of wave 3. At the end of this wave, or at the percentage of retracement, you can enter the market and start trading the Elliot Wave Theory, putting your stop loss somewhere above or of the wave 3. So if we would enter here short, we can place our stop loss somewhere around here. Now let's talk about wave 5. Wave 5 is the last leg in the direction of the now dominant short trend. At the end of this wave, momentum indicator starts showing divergences, and we have the full effect of the now prevailing downtrend. After the first 5 legs of the dominant trend, the corrective trend begins. Wave A is considered only a correction of the now dominant trend, and it can go up to the beginning of wave 5, it depends. Next comes wave B. In wave B, these waves A and B are not numbers anymore because Elliot wanted to show that the direction has changed. So 1, 2, 3, 4, 5 are for the same direction, long or short, and A, B, C waves are on the opposite direction. In wave B, prices reverse lower, but usually not lower than 50% of leg A, and a head and shoulders formation starts forming. There is another entry here at retracement point of leg A, or you can enter when a bottom is formed on leg B based on candlesticks formations. We see here leg B, that is a retracement of leg A. The last wave, wave C, is typically the same size as wave A. That's why you can put your take profit after measuring the length of wave A. And the Fibonacci expansion tool is specifically used for this reason. It measures the wave A and gives you a target for wave C. So now that you know how an Elliot wave looks like, let's go to cTrader and I'm going to show you a bullish Elliot wave. I'm going to quickly draw it so that you understand how a bullish Elliot wave looks. So we have here a chart of out Japanese yen of 1 hour. And I have previously drawn the points of the Elliot wave. So we have previously a downtrend. Now we have a new retracement of that trend, and we have a leg leg 1. Sorry. After the retracement of leg 1, as we said before, there is wave 2. Then we have wave 3, which goes beyond the high of wave 1. Then we have the retracement of wave 3 at wave 4. Then in the end we have the biggest wave, wave 5, which is the top of this new prevailing uptrend. It doesn't go higher, and it's not going to go any higher. Then we have a big retracement of wave 5, and we come to wave A. Then we have a retracement of wave A to B, when a head and shoulders has clearly formed now. And when we have a wave C, which is, as you can, if we measure the waves, you'll see that wave A is 97 pips, and wave C is 115 pips. So wave A is practically almost always the same as wave C. Now that I have demonstrated a bullish and a bearish Elliott wave, let's talk about some principles of the Elliott waves so that you understand better how you're supposed to trade them and how they work. The first important principle of Elliott wave is that Elliott waves are very rarely perfect. I've shown you waves that are close to perfect so that you can you understand easier how an Elliott wave is supposed to look. But in reality, Elliott waves are really open to interpretation by traders. They are sometimes a bit subjective, and they are rarely completely perfect. The second principle of Elliott waves is that Elliott waves are fractal in nature. What does fractal means? Fractal means that if we identify an Elliott wave in the 1 hour time frame, for example, if we take wave 1 of that Elliott wave and we zoom in or change time frame to 1 minute time frame, or I don't know, like 5 minutes time frame, we're going to see that this wave also is made out of Elliott waves. And if you zoom more into the price and go to the tick charts, you're going to find Elliott waves making every wave of the M5 chart. That's what fractal means. It means that you can zoom more and more and more, and you're still going to be finding Elliott waves that make other waves. Kind of hard maybe to understand, so let's go to cTrader. I'm going to help you understand by giving you an example. So for that example, we're going to use the 30-minute chart of USD Japanese yen. We see here a bearish Elliott wave. We have wave 1, we have wave 2, wave 3, wave 4, wave 5, A, B, and C is still in development. Someone can say that C has finished here, still going up. What I want to show you, however, is I want you to concentrate on this area. We see here wave 4 to 5 and 5 to A. Now what we're going to do is we're going to go to the 2-minute time frame of the same currency pair, USD Japanese yen, and we're going to zoom in into this area here. So let's go. And as we can see that we have, again, this is the big wave 4, so let me mark it for you. You see this 4 here. Let me move it a bit. The 4 here is, this 4 is the end of this wave. So this is where wave 4 ends. But what we're going to see is that this is the wave 5 of the big 4 to 5 of the big time frame, but we're going to see that it's also made out of Elliott waves. We have again wave 1 on the retracement, wave 2, 3, 4, 5, again A, B, and C. That's what fractal means. It means that we have an Elliott wave in M30 time frame, and if we zoom into the price here, we're going to see that each wave of the bigger wave is also made out of Elliott waves. The next principle of Elliott waves is that very often the last wave of an Elliott wave, wave C, is also the wave 1 of an Elliott wave that goes to the other direction. So for example, if we have a bullish Elliott wave and wave C is bearish, then we can start, wave C can be also wave 1 of another Elliott wave. Sounds kind of confusing. Let's go to cTrader and I'm going to show you what I mean. We are again on the presentation, so I have a slide that I've shown you here. We have a bullish Elliott wave, so we have wave 1, 2, 3, 4, 5, A, B, and then we have wave C of the Elliott wave. This wave C of the bullish Elliott wave is also wave 1 of a bearish Elliott wave. So it starts wave C and 1, 2, 3, 4, 5, again A, B, C. So this is what I meant. Elliott waves are often connected together. So now that we've talked about the principles of Elliott wave, I want to show you how to use Elliott waves in your trading. We're going to trade the Elliott wave that we found on M2 of USD Japanese yen. So let's go back to cTrader. I'm going to show you what tools you should be using and how you should be thinking. So we see here USD Japanese yen M2. We start looking at the price after the first big retracement of a trend or a big directional movement. In this case here we have wave 1. There was a previous uptrend or another Elliott wave finishing. We have wave 1 here. The first wave is always, this wave is always considered a retracement, and we cannot just trade it like an Elliott wave unless the first wave is also wave C of another Elliott wave, like I showed you before. In this case, this doesn't happen, so let's just continue. If it seems that wave C is also wave 1, then we can enter the retracement of wave 1 using a Fibonacci retracement tool. So we can draw here Fibonacci retracement, and we can enter on 50% level. So let's mark 50% level. That is not marked here. Let's change it. We can enter around 50% is a good entry for that, or depending on your personal choice, on maybe another retracement level. Alternatively, you cannot use Fibonacci retracement. You can use moving average crossovers on the retracement or Japanese formation to find retracement or whatever. This way we can get the Elliott wave 3. So let me show you again. Let's assume that we have drawn a Fibonacci retracement. We enter at 50% retracement of wave 1. So here we're going to get wave 3. You can exit any way you think. You can use the same tool to get an expansion of wave 1 or whatever, or another exit method. Next, we can trade also the retracement of wave 3 using the same technique, Fibonacci retracement, for example. So we can again enter on the 50% level of wave 3. You see it goes exactly that in this case. We're very lucky. And you need to remember that for wave 4 to 5, you need to have a big target, because wave 5 is usually the biggest one. After wave 5, you do not trade the A wave. You wait for the retracement to happen naturally. What you do is trade the retracement of the A wave to get the C wave. For that, we usually use the Fibonacci expansion tool. And what we do is we measure wave 5 to A, then we measure wave B. We see here 5 to A to B, and the Fibonacci expansion tool is going to give us a target which is 100%. What this target says is it's actually giving us the same number of pips from 5 to A, 13 pips, as a target. So again, 13 pips. Because like we said before, usually in most cases, wave C is exactly the same length as wave 5 to A. B to C is the same as 5 to A. So we're going to hit our target here. It goes almost exactly the 100%. It continues going higher. In this video, we talked about the Elliott Wave Theory, and I've shown you how an Elliott Wave is made. I've showed you the principles of Elliott Waves. I explained the fractal nature of Elliott Waves, and I also showed you how you should be trading it and what tools you should be using. So you should not have any questions by now. Just remember that Elliott waves are a bit subjective. They're open to interpretation by traders, so you need to be extra cautious sometimes. If you like this video, don't forget to subscribe, and if you want, share it with your friends. Thanks for watching.